Hello class, welcome to my video. This is chapter 4 for your financial accounting tool. So what you can learn in this chapter 4? Chapter 4 is related to your introduction of limited liability company. Upon completion of this chapter, you should be able to understand the features of limited liability company, the types of share and debenture in limited liability company, and the accounting treatments when you issue the shares, right issues, or bonus issue. So let's start. What is limited liability company? A limited liability company is a corporate structure whereby the members of the company are not personally liable for the company debts and liability. An owner of or members of limited liability company is called as shareholder or equity holder. So imagine you are the shareholder of the company. So today you invest, let's say 10,000 in the company. Your investment will be treated as share capital. So assuming this is a limited liability company. So today if the company is not doing well, let's say the company owing to bank 100,000. So my question is, the shareholder required to pay the bank 100,000 on his personal money? Is the shareholder of a limited liability company required to use his own wealth, own money, to pay the bank 100k for the failure of limited liability company? The answer is no. Because under limited liability company, the shareholders' liability is limited. Limited to how much? The share capital they invest. Let's say the share capital that this shareholder invest 10k all gone, okay, all used to pay the debt. So this will be the maximum loss for the shareholder. Shareholder is not required to use his own money to pay off the debts. So these are quite different as compared to sole proprietor and partnership. Because for sole proprietor and partnership, if the business is not doing well and incurred additional loan, the shareholder is required to pay on behalf, because the owner for sole proprietor and partnership is having unlimited liability for the debts of the company. Alright, let's go back to textbook. So we have two types of limited liability company. The first one is public limited company. So what is public limited company? The share of public limited company are listed in stock exchange. Owner or member are freely to buy or sell a limited liability company shares in the stock exchange or share market. Any major information of the company will be announced through the stock exchange. So what is the example of public limited company in Malaysia? Like Maybank, CIMB, Petronas, those are the company listed in Malaysia. So if you want to buy the company share, those listed company share, how you do? You buy through the stock exchange. At the same time, you can freely buy or sell without any restriction. So in Malaysia, normally for public listed company, we use Berhad. For private limited company, we use Sendirian Berhad. So what is private limited company? Owner or members of private limited company are not able to sell their share to public or in open market. It means that you cannot sell the shareholding in private limited company in stock exchange and ask people to buy from you. You cannot do so. At the same time, you cannot buy limited liability company shares from the stock exchange. Any changes in the private limited company are not required to publish. So in a limited liability company, we have two types of share. The first type is ordinary share, and second type is preference share. So let's take a look. What is ordinary share? The holders of ordinary share are the owners or members of a company. So this will be treated as equity in SOFP. If you having ordinary share, you having the voting rights in the AGM, and you can make decision for the company. Let's say to invest in project A, B, C, for example. In the case of dissolution or cessation of limited liability company, ordinary shareholder will be the last one to recover their investment. It means that when the company is closed, you are the last one to get your investment. The holder of ordinary share may be entitled for ordinary share dividend as reward of investment, but this is depending on the company performance. The nature of ordinary share dividend is not fixed, hence it is treated as equity payment in financial statement. So if you buy an ordinary share in a limited liability company, you may get reward if the company is doing well. This reward is called ordinary share dividend. But take note, this ordinary share dividend is depending on the company performance. Let's say the company is not performing well, you may not entitle for any dividend. But if the company is doing well, you may get more dividend. So the nature of ordinary share dividend is not fixed. It means that the amount is not confirmed. This is variable. So this will be treated as equity payment in financial statement. Next, what is preference share? The holder of preference share are the creditors or lenders of the company. Take note, holders of preference share are the creditors or lenders. It means that they are not the boss, they are not the owner. So preference share is treated as non-current liabilities in the statement of financial position. They do not have the voting rights, so they cannot attend AGM and cannot make decision making for the company. In case of dissolution and cessation of limited liability company, they are prior than ordinary shareholder to recover their investment in limited liability company. It means that they can take the money before ordinary shareholder. The holder of preference share will be receive preference share dividend as reward of investment, regardless the performance of the company. The nature of preference share dividend is fixed, hence it is treated as finance cost or interest expenses in financial statement. The preference share dividend can be either cumulative or non-cumulative. For preference shareholder, you can get preference share dividend as a reward for investment. But take note, regardless the performance of the company. It means that even the company not doing well in their business, they still need to give you preference share dividends. And the nature of preference share dividend is fixed. It means that no matter company is doing good business or bad business, you still can get a fixed amount. So the preference share dividend will be treated as a finance cost or interest expenses in financial statement. And there are two types of preference share dividend. The first one is cumulative. Cumulative means dividend will be accrued to next year if unpaid. And for non-cumulative means dividend will be forfeited if unpaid. Cumulative, very simple. If this year you cannot pay, the company cannot pay you, next year they still need to pay you the dividend amount. But for non-cumulative, if the company does not have the ability to make payment, this amount will be forfeited. So the next table, I have a summary of preference share and ordinary share. For ordinary share, they are the owner of the company. Preference share, creditors. Ordinary share treated as treated as equity in SOFP. Preference share treated as non-current liabilities in SOFP. If you're having the ordinary share, you can have the voting right in AGM. If you are holding preference share, no voting rights. Next one, ordinary share. Dividend payment will be treated as payout of equity. For preference share, dividend payment will be treated as finance cost or interest expenses. Next one, for ordinary share, no guarantee return. Preference share, fixed rate return, regardless the performance of the company. And for preference share, we have four types. First one, redeemable preference share. What is redeemable preference share? It means that you can get back the amount you invest. For irredeemable preference share, you cannot get back the amount you invest. It means that this is a not long-term investment. You will not collect back your amount. Next one, convertible preference share. Convertible preference share means that you are giving a rights to convert your preference share do the ordinary share of the company. And non-convertible preference share, you are not allowed to do any conversion. So these are the types of preference share. Next, in limited liability company, we have something called debenture. So what is debenture? Debenture is a debt instrument used by company to borrow money from external. The terms of debenture tends to be middle or long term. Debenture holder is the creditor or lender of the company. Debenture will be treated as a non-current liabilities in financial statement. Generally, debenture holder will receive fixed interest income from the company as reward of investment. The debenture interest will be treated as interest expenses or finance costs in financial statement. The interest expenses paid to debenture holder must be accrued if unpaid during the financial year. So from this explanation, we can see that debenture is very similar to what? Debenture is very similar to preference share, because they are the non-current liabilities in the company. They are the creditors, they are the lenders, they do not have voting rights, and then their return is what? Fixed. So the only difference between debenture and preference share is, for preference share you can convert to ordinary share, and for preference share you have non-cumulative. It means that dividend will be forfeit if unpaid. For debentures, all the interest must be paid in next financial year if unpaid during the year. So this is a table of comparison between ordinary share and debenture. Ordinary share, owners of the company. Debenture, creditors. Ordinary share, equity in SLFP. Debenture, non-current liabilities. Ordinary share, giving you voting rights. Debenture, no voting rights. If you invest in ordinary share, you get dividend. Invest in debenture, you get interest. Ordinary share, no guaranteed return based on the company performance. Debenture, the return is fixed and regardless the performance of the company. The next section, we are going to explain what is revenue reserve, what is capital reserve. For revenue reserve refer to the sum of money retained in business so as to meet up future contingency. Revenue reserve can be used for dividend payment to shareholder. Example of revenue reserve are retained earnings and general reserve. The next reserve we call capital reserve. What is capital reserve? Capital reserve refer to a fund that is created to finance long-term project or write-off capital expenses. Capital reserve cannot be used for dividend payment to shareholder. Example of capital reserve are revaluation reserve and share premium. So in simple words, revenue reserve can be used for dividend payment, and capital reserve cannot use for dividend payment. Capital reserve is used for long-term project financing and write-off of capital expenses. So that's all for the explanation of ordinary share, preference share, debentures, and the types of reserve. In the next section, I'm going to share with you what is the accounting treatment when the company issue share to others. So that's all for this section. I will see you later. Thank you.